Welcome to FinLoop.
Okay, let's dive right in. Today we're tackling a huge question that's hanging over, well, pretty much the entire market. Is this whole AI revolution just getting started, or are we partying like it's 1999 all over again?
So that's the core debate. And to really get to the bottom of it, here's what we're going to do. We're going to break down 3 really common myths that are floating around about the AI boom, and then we'll look at the crucial warning signs you need to know about.
All right, first things first, the big picture. The bulls, right? You're arguing we're in 1995. They're saying this is just the dawn of a whole new technological age with tons of room to run. But when you really dig into the data, especially the valuations and how the market's acting, it starts to look a lot more like we're closer to that final frenzied peak of 1999.
Okay, so let's jump into our first big myth. And that's the idea that the AI growth we're seeing today is basically just following the same playbook as the tech boom we saw back in the 2010s.
You remember the 2010s, right? You had companies like Meta, Facebook back then, that could add a new user for practically zero cost. That's what people called hyperscalability. And man, was it profitable. It meant you could have this insane growth without having to pour a ton of new money in. But here's the thing. The AI era, it's a totally different story. This isn't just about clever software anymore. Nope. This is about building these absolutely colossal, power-hungry data centers. It demands just enormous, and I mean ongoing investment in actual physical stuff.
And that brings us to a really key concept you got to understand here: capital intensity. Now, just think of it like this. It's how much money a company has to spend on physical assets, the stuff, to generate a single dollar of sales. So the higher that intensity, the less free cash is left over for investors. And what we're seeing is that for big tech, this number has fundamentally gone up.
And wow, just look at the impact of that right here. Big tech's capital spending, as a chunk of their earnings, is now sitting somewhere between 50 and 70%. Now, to put that in perspective, that's right up there with where AT&T was at the very peak of the telecom bubble and where Exxon was at the top of the energy bubble. And historically speaking, that level of capital intensity has not been a great sign for investors. All right, on to myth number 2. You've probably heard it before, right? The 4 most expensive words in investing. This time is different. So let's see just how different it is by comparing today's AI darlings to the giants of the dot-com era. Okay, this is where it gets really, really interesting. Look at the parallels between NVIDIA today and Cisco back in 2000. Cisco was basically the NVIDIA of the internet. They made the essential hardware that powered the whole thing. It was an absolute must-own stock, trading at over 20 times its next 12 months of expected revenue. Sound familiar? Just like NVIDIA today. But here's the kicker. At its peak, Cisco was worth 5% of US GDP. NVIDIA today is worth a mind-boggling 15%. And it's not just an NVIDIA story. We see this with other high flyers too. Let's compare them to Microsoft at the absolute tippy top of the 1999 bubble. Back then, Microsoft was this hyper-profitable monopoly, growing over 30% a year. Now, look at a company like Palantir today. Similar growth, sure, but it's trading at 75 times its expected revenue. Not earnings per share, but revenue. That is an incredibly rich valuation, even compared to the craziest days of the last bubble.
And that right there is such a critical cautionary tale. I mean, let's be clear, Microsoft was and still is a fantastic company. But if you were the person who bought that stock at that inflated price back in 2000, you had to wait 15 long years just to break even. It just goes to show even the best company in the world can be a terrible investment if you pay too much for it.
Okay, let's bust our third and final myth. This is the idea that, hey, the broader market is actually cheaper than it was in 2000, so we've got some sort of a safety net.
So back at the peak of the dot-com mania in March 2000, the S&P 500 was trading at a price-to-earnings ratio of 25.
And today, that number is a little bit lower, sitting at 23. So you look at that and you think, okay, that seems like good news, right? A little cheaper, maybe we're on safer ground. But, as you probably know, a P/E ratio never tells the whole story.
Because what's so critical to remember is the fundamental backdrop. It's just so much weaker today. Think about it. In the 5 years leading up to the 2000 peak, company earnings were growing at a blistering 18% per year. Today, that number's down around 10%. And maybe even more important, back in '99, the US government was actually running a budget surplus. Today, we're in a deep, deep deficit.
So, once you strip away those myths, a few pretty clear warning signs start to come into focus.
What we're looking at is kind of a dangerous trifecta. You've got these really rich valuations, you've got increasing macro risk, like that government deficit we just talked about, and you have company fundamentals that are actually getting weaker, like that rising capital intensity we saw earlier.
And then, on top of all that, you've got the speculative behavior. I mean, it's the kind of frothiness you typically see right before a major downturn. You know what I'm talking about? The return of meme stocks, the explosion in these super risky short-dated options, and the widespread use of leveraged ETFs. These are all classic signs of a late-stage retail mania. So when you pull all of this data together, it really leaves us with one crucial question that we all need to consider. When you look at the 1999-style valuations, when you see the fundamental business models changing and you see all the frothy behavior in the market, it really leads to the ultimate question every investor has to ask themselves right now. Subscribe to FinLoop for more short-form insights on finance, investing, and global markets.